Hello, 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 and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Here we go, here we go, here we go. This is 50 pips, 22nd of April, 2018. No trade calls or recommendations are responsible for their own stuff. We're here for educational purpose only, and let's do this. So, what's going on this week? Well, it should be an interesting week. We've got plenty of still headline risk out of the Middle East, out of Washington. That hasn't changed. We're going to have a lot of data out, and especially ECB and BOJ. So we'll have to see what gives. But clearly, the scene is set for potentially more volatility and some decent moves ahead, right? So I think the main issue here, right, the main issue that most people are going to be focused on this week is going to be the dollar, right? And as we've seen some of the currency pairs try to accelerate, it's led to a lot of people thinking, especially with the move we've seen on some of the commodities, on gold, on treasuries, is the dollar ready to squeeze, and is the dollar going to break out hard and catch everybody off guard with this record short positioning? Now, as far as we're concerned, not much has changed in terms of the bigger picture where we're stuck in this sideways chop, but it does look like we're closer to a potential break. Now, clearly, because of this positioning, if we get back above the 91s, and you see how we're making slow progress back towards 91s, the pop through 91s into 92s could be or could happen extremely quickly, and I think that's the big risk. Now, having said that, even if we get there, this could still be holding the trend for a move lower. So it's not a done deal, but clearly this is what you have to keep an eye out for this week, right? And especially linked to those treasuries. So key chart, we'll have to see what happens. Some of the currency pairs are already on the move. A lot are still stuck in the middle of the range, right? For example, you've got something like the Kiwi. If you go on a weekly, and we've looked at this chart for a long time, you see how we're trading very neutral, right? Not an awful lot has changed. We're trading very neutral here. Whereas if you look at something like cable, which we highlighted on the blog as this was forming, you've got a beautiful little roll here on the daily, right? Almost as pure as they get. This actually rolled on a 4-hour setup. Chance to trade this extremely tight on a failure at yearly highs and a nice little roll. Right here, we're holding pretty much in. Oh, this looks like this has moved. Let's see if we can get it back. Still haven't figured how this channel works it keeps on moving. Anyway, so here you see how we're back in mid. So this is a very, very big test, right? Probably a bunch of moving averages here too. But if we can hold, then time for a bounce. If this lets go, this could be very, very aggressive. The way this is trading, this kind of pattern, you'd probably expect bounces to get sold as trapped longs get out. So even here, even if we bounce from here, if it's going to be a strong bounce, we would expect it to have to be something like a double bottom or something like that. But the way this is trading, this looks like it's very, very heavy. But again, going back to what we said, some of the currency pairs have really broken out, and others haven't really, right? So it's not really conclusive. You see euro still stuck here. Our base case is still that it's stuck here doing nothing. A lot of people are going to say, oh, well, this is coiling up. We don't think the coil is that pure. We're still looking at this as the DXY, as stuck in a rectangle, so not an awful lot going on. We're seeing some potentially interesting action on the yen, right? If you look at it on the weekly, basically our base case was still that this is going to try and make its way back to the 100. So as far as we're concerned, this is still a corrective bounce, which could move all the way back into the 109.50s and then puke. So again, here you're going to have people saying, okay, this is bouncing, this is going to rally hard. Sure, there's easy for how should I put this? This could easily move up 200 pips, and this still doesn't really change our bear case, right? So we still see these moves as corrective. So there's nothing. It's not like every single the dollar started rallying against all currency pairs and it's really getting traction. It's trying, right? That's the key message we want to get across. It's trying. The other interesting thing to keep an eye out for is really these treasuries that are not catching a bid, and we've had very, very nice moves here. Our base case hasn't changed. right? This was a move back into mid-channel, front run of the 50 back. We're still looking at the very least for a move back into the 131.12s, this area, and this is back in play. You see nice little chance to trade this with very tight risk on the daily. Actually, it was also a 4-hour play for a move back down. This is a very, very nice trade. But again, the other one most people are talking about are the ZNs, right? And this is another one where this could get very, very, very ugly very quick. See how same thing here. We had a little reversal here. This already printed the 123 extension of this move. And now what we said is either this was going to bounce, or our base case, because of the action, is that we still have more downside to go. And here you see another nice chance to trade this very tight risk reward for the move lower. So here, especially the ZNs, is there going to be a flush or not? That's the big question. Everybody's been looking for this to just be one last flush and then they rotate higher, but they're not. They just keep on getting steady selling. And we'd suspect you're probably still more selling at least into the end of the month. And here, clearly, as long as we hold below this 123, it could get ugly. Now, sooner or later, there'll probably be a good chance to buy, especially from an intraday basis. But for now, it's anybody who's been trying to step in front of this train are getting run over, right? This is just, I hate saying it, but this is really being the easiest trade, really, right? Just this short bonds. There's just not catching a bid at all. Now, and again, we've seen a lot of interesting action on the financials, you know, all those really good earning reports, and then they just can't hold. They close lower at the end of the day. You see the way Apple traded, right? So the market's really on trading heavy recently. I mean, we'll look at the market in a second, but you even see here Apple on the daily, right? And we've talked about this a lot, and I said, you know, there's nothing bullish about this kind of pattern at all. Right, there's nothing bullish at it, and the way here you're getting these two gap downs like this. I mean, is there going to be a buying opportunity sooner or later? Sure. Do we think it's a long-term one? Probably not. But the way this trades is very similar to what we looked at on cable, right? Even if this bounces, you'd still expect, if it's going to, you would not expect this to bounce hard off this 200 straight away, right? Either you'd expect this to continue to go lower and try and bounce lower, but then if it goes lower and bounces, that previous support is going to be resistance. Or more likely, if it manages to catch a little bounce, it'll have to go lower, and then the retest will be the bull bear line. But again, it's not particularly bullish. Now, having said that, and I don't want to sound too boring, it's the same way as what we discussed on the DXY, right? Look at the ES. We're not falling off a cliff, and we're not exactly making new highs, right? If you're looking at it in terms of how did we close the week, well, not pretty, because you got a nice little smackdown at the end of the week. So our base case is still that we have to ultimately make our way back towards the 2450s, right? That hasn't changed at all for us, but it's a labored process. And right now, the bears are going to argue that, again, this was a very heavy failure at the 2700. It tried to get back above these two moving averages. It couldn't. It's closed back below. So any rally is a sell because this is coming lower. And the bulls are going to say, no. This is just, we had a nice little leg higher. We're going to retrace a little bit. We'll catch it well ahead of this 200 again. Anyways, we'll keep on making another series of higher low. And we're off to the races. We're going back higher. So you could really argue for it both ways. Our base case hasn't changed, right? Because of the velocity of the moves to the downside, because of the context, because the way it's been trading relative to volume, because of the way it's been trading relative to all the other instruments, how we've been discussing this on in the daily webinars. The live context to us indicates that the path of least resistance, even if labored, is lower, but can very well see why people are arguing for higher. And that's what makes a market interesting. But right here, it's really hard to be very, very certain about any other outcome. See, on the NASDAQ, same thing. Here, we said close above the 50 is bullish. So you would have expected this to happen. Close above the 50, move back, the 50 holds, and then it tries to rip into the 7,000. Beautiful chance for the bulls. they didn't, didn't really manage to materialize or get traction there. And so here, what you'd have to expect is if we close below the 100, now it's the bulls had a chance, they didn't manage to rip it. Now if we close below the 100, the bears have a chance. Any rally back into the 150, that's the sell for the move back into the 200. So you see, it's kind of like a ping pong match between the bulls and the bears here at this mid-range where the market is trying to top, but on the moves lower, it is making higher lows. Now, the volume isn't too convincing. Again, it's not because it's on low volume that it's not real, but when you get those overnight ramps, those ramps on low volume, they usually give back very quickly, at least in our experience. So again, not too conclusive. Now, what else have we got? Gold. Again, you can run, but you can't hide from the correlations here. So it's it's a dollar. If the dollar catches a bid, you'll see gold continuing trading heavy. If the dollar doesn't, at least short term, gold will try and take those highs here. So again, even here you see on the gold, it looks like it's continuing to fail here. And even if it's going to go higher, it probably needs to go from a lower level. So it's probably going to try and come in here and test these lows. But again, very, very choppy, very congested area. And it's so tricky because all it's going to take is one headline out of Middle East, one headline out of North Korea, one headline out of Washington, out of Mueller investigation, and everything can change. That's what makes it interesting. That's what makes it tradable because of the volatility, but that's what makes it also a little bit difficult. Speaking of volatility and headline risk and head fakes, another chart, probably the last one we'll look at here, is the crude chart. Actually, before we look at crude, do I have it up here? Keep an eye on the Shanghai Composite because it's you can look at different ones, but it's trading very, very heavy. So especially if you're coming into London in the morning, just take a peek at what Asian markets did. Take a peek at what this Shanghai Composite is doing because this is a very, very heavy, trading extremely heavy. Here, if it can flush this zone again, there's been a lot of support here. If it can flush this zone, the move lower could be very, very aggressive. So the market will have to pay attention if that happens. So I'd keep an eye on that chart too. And in terms of crude here, so we've made our way back towards the 70, and that's what's being defended. So clearly, no day close above the 70 mark, no ability to attract new buyers and squeeze this higher above the 70. Also because of the record long position here, you'd expect the path of least resistance to be some kind of a correction. Now, the two levels we'd be looking at on any kind of weakness is around 62.60s and then these 66.60s and 62.60s. So unless something crazy happens and you get a super strong dollar bid or something, you'd expect one of these two levels to hold on any retracement if the 70 doesn't give. And this move could be very, very quick. Now, if something changes and there's an awful lot of unwinding from the long side, so this could get ugly. But here, even if it's squeezing, the asymmetric risk reward is clearly to try and play the downside. It doesn't mean you want to be stubborn. It doesn't mean you want to close your eyes and keep on selling this and hold an awful lot of overnight risk. But it means that intraday, tactically, at least for us, the short side is a lot more interesting than the long side. So hope that was useful. As usual, thank you so much for listening in. Thank you for liking. Thank you for sharing. I'll see you guys on Twitter. Hit me up if you want me to post any chart, and hope everybody has an awesome week ahead. Take care, guys. Bye-bye.